Welcome to Talking Property. Today, Australia's best property analyst, Louis Christopher, and I will preview the 2020 Sydney property market. Louis, thanks for joining us.
Nice to be here, Peter.
Louis, straight up, what's your forecast for 2020, please?
For 2020, for Sydney, we are forecasting price rises between 10 to 14%. So
that's on top of what we've already seen in 2019.
Yes, it is. This assumes that interest rates will not be cut. Now, as you know, at the end of 2019, the Reserve Bank of Australia was making increasing noises that potentially rates could be cut. So we've run a scenario where we assume another rate cut. And that scenario basically then projects out that prices will actually accelerate from our 10 to 14% forecast. And a 25 basis point cut would mean prices would rise in more in the order of about 11 to 15%, especially if it were to occur earlier in 2020.
Louis, if the market does play that way, do you think the market is at risk of overheating? And if it is rising that bullishly, will regulators step in like they have in the past to slow it down?
Our view is that yes, the market is at risk of overheating, and we have stated that we believe that this new upturn will not have that much legs in it. It will not last that long. It'll be a shorter cycle than previous cycles, precisely for the notion you put forward that it is likely APRA will eventually step into the market to slow down the over-enthusiasm that's coming from the market.
In the 2017 federal budget, the government gave APRA the power to be postcode specific in how they dealt with property markets, or region specific.
Yes.
Do you see that happening where APRA may look at parts of Melbourne, parts of Sydney and say this is overheating, we need to take the heat out by slowing down lending in these markets, but in other markets that are not as performing as strongly, happy to let the running go?
Well, APRA, of course, use their powers via the banks. And Peter, you may recall that we went through a period, especially during 2018, where the banks effectively black spotted certain postcodes. That was policy in action, effectively executed by the major banks. APRA have a lot of powers at their disposal now across not just the banking sector, but the non-banking sector as well. Their latest language is suggesting that they welcome the price rises and they're not overly concerned until such a time that credit growth starts to really accelerate. And up until now, the data on credit growth has actually been fairly benign.
That's an interesting conflict in the market, if you like, isn't it? Or a contradiction, that credit growth's not strong, but property prices are.
That is correct. With the new rise in the market, I do think it will feed through to credit growth accelerating sometime potentially in later 2020. And at that point, APRA may well step in. But it also depends what the economy is doing as well. And this is where we've got problems with the economy, because the economy is tied to the hip with housing. And as stated previously, we've got an issue on housing construction and job losses, which are occurring in housing construction right now, creating a bit of a dampener on the economy. That may well hold APRA at bay for some time.
Louis, in your forecast of 10 to 14%, what do you think will be the best performers in the market?
So far in this new upturn, the regions which have been outperforming in Sydney have been the inner west, the northern beaches, to a lesser extent the east and lower North Shore. We've seen rises elsewhere as well. The upper North Shore has been doing okay. Sydney's south, Sutherland area, Sutherland Shire has been doing well. Sydney's northwest, less so, except for established houses.
That's an oversupply issue again, is it?
This is still an oversupply issue that's occurring in Sydney's northwest. It's also been the areas which experienced a big fall in 2018. So as you know, the inner west for established houses had quite the correction in 2018.
In percentage terms, what was that, please, Louis?
Roughly, it was about a 15% correction.
Has the market made that back up?
For the inner west, it's showing that we're now about to break the highs that we had in 2017. So we're about to hit new fresh highs for 2020. I think for Sydney overall, we'll break the high somewhere about second to third quarter.
Louis, investors, I want to talk about investors that are in the market, landlords. For some time now, they've faced rising costs, savage land tax bills each January,
Yes.
And unfortunately over the last 5 to 6 years, stagnant if not falling rents.
That's right.
Is there pressure on landlords in their ability to hold property, and do you see a scenario where they decide to sell out because the prices on offer justify selling as opposed to holding a property with stagnant income?
We may well see that over the course of 2020 and 2021, Peter. It's a very good point. Right now, landlords are not getting a lot of bang for buck in terms of the rental side. They are right now, of course, getting capital gain, and that's what many of them are in the property market for. But yeah, in terms of the rental side, it has not been too pretty at all for Sydney landlords for, well, really since 2017. So it's been a tough rental market since then. Now, our forecast on the rental side is that it will slowly improve for landlords. Rental vacancy rates should be peaking right about now in the Sydney market, and we'll see a slow fall in rental vacancy rates over the course of 2020 and 2021. Let's recall that we're having a major building slump right now. That's going to create a shortage of rental properties, especially over the course of 2021 and 2022. And I think that those years you'll see the market swing well and truly back into the favour of landlords.
Louis, we increasingly keep hearing globally and here at home about quantitative easing, which is printing money.
Yes.
And we keep hearing about negative interest rates.
Yes.
Can you see a scenario in Australia that we find ourselves with negative interest rates?
Well, anything's possible, Peter. We need to look at the reasons why we are having negative interest rates around the world. In my view, it is because there's a lot of debt in the system. Therefore, borrowers' capacity to be able to take on more debt is not really there. Many borrowers around the world are trying to pay off debt as much as they can. They're using their disposable income to do so, and that has an impact upon consumption. And yes, we're not immune to negative rates. Now, the RBA has flagged in later 2019 that they believed that it would be unlikely that we would get to negative rates. They have, though, also flagged that they may well try quantitative easing, and they've been preparing themselves for that. They took the view that they wouldn't do quantitative easing unless the cash rate gets down to 0.25%. So we're not at negative rates in this country yet, but there is that possibility, especially if we had the unfortunate event of the economy going into recession.
And do you think that rate cuts, where the cash rate at the moment is at 0.75%, do you think that interest rate cuts have the same impact now as they once did? The last rate cut that came in October 2019, the banks only passed on 0.15% of the 0.25%.
This is the issue, that it's likely for any further cuts that the major banks will not be able to pass them on in full, because they have a depositor cost base that they have to work with. So it is quite likely that if we were to see a 25 basis point cut again, banks would pass on 10 to 15 points. We'll see. We don't know. It just depends on what international banking costs are also like as well.
Someone who worked at one of the big four banks explained it to me this way when I was discussing with him why his bank only passed on 0.15% of the last rate cut. Is he said that that bank doesn't actually get their borrowings from the RBA anymore. They get a lot of their borrowings from offshore, and when the RBA cuts interest rates, that doesn't really have an impact on their ability to lend to the consumer, because they're raising money elsewhere.
Yes.
And the RBA are going to have to print money through quantitative easing in order to funnel money back through the retail banks. Is that how you see it?
Banks do rely on the RBA to an extent, especially for shorter term money.
Yes.
So they can and will borrow from the RBA, but it is true that over the years, the banks have been increasingly reliant on overseas funding. And of course, they're still very reliant on their local depositor base, all those term deposits, all that at-call money that us as consumers leave our money in. they're relying on that as a cost base. Now the thing is, when it comes to the depositor side, that's very fixed. It's very hard for the banks to actually offer, say, a negative interest rate as a term deposit. They cannot really do that. No one's really going to take it up on that unless things get real dire.
Yes.
So that's why they're somewhat restricted because of their cost base. Not that I want to give the banks a pass. I think that there are certainly things that they could improve in their business of banking, but it does become increasingly difficult for them to pass on such rate cuts in full.
They've got serious structural challenges that they're not getting the political coverage from the government of the day.
Absolutely, they are. I think their core business of just straight out lending has become that much more difficult, and little surprise that we've seen a huge rise in the non-bank financial sector.
Yes, indeed. Louis, in your forecast there, is that for dwelling prices or is it for houses specifically? So how do you think the housing market will perform in comparison with the Sydney apartment market?
Our base case forecast of 10 to 14% is for dwelling prices. So that's a range for all dwellings. Our expectation is that freestanding houses, will outperform units overall. But we don't think established units that have been around for some time, where there's no concern over cladding, where there's no structural issues, those type of units will likely do okay in the market. And the main reason is affordability.
So grading the market, if you like, you think housing will do best,
yes.
Established units after that, and
yes.
brand new high-rise apartments will probably be the lag, so to speak, on the market. Will those brand new apartments, do you see any growth in 2020 in those?
No. It's very hard to see it at this point in time. There's a lot of issues. The general public's aware of the issues in the sector. There still remains a lack of confidence there. That will change in time. Let's not forget that the Sydney population growth rate still remains at roughly about 1.7%. So it's still very strong. The city is expanding by some 100,000 people each and every year now.
And I think those apartments with defects, if they seem to have one thing in common, they're under 10 years old. So I think anything that's existed for 10 years or more, the known issue seems to have come to the surface, don't they?
This is true. Unfortunately, in the last boom that ran from 2013 through to 2017, there were a lot of dodgy developments that came up. A lot of developments were built very quickly. They were backed by foreign investors who had really no understanding of how the local market operates here.
Louis, if you're saying 10 to 14% on dwellings and brand new apartments will be a lag on the market, that's suggesting there that you see some house prices running 15 to 20%, possibly more in 2020.
It is possible, especially if we get another rate cut. Now, that all said, there is also another scenario, a more bleaker scenario that we should consider. And this goes back to our discussion on negative rates. If the Reserve Bank of Australia is forced this year into cutting rates to zero, we're going to look at the reasons behind that. And I think that will be because they will be very concerned that the economy is teetering on recession. If the economy does go into recession later this year or at some point, that's actually going to be very bad for the housing market. It'll mean that we're seeing job losses, which affects demand for housing, and confidence could quickly sap away on that scenario. So people would think, okay, great, they cut to zero, that means money's really cheap. Well, no, because firstly, as we've just discussed, the banks won't necessarily pass all that on. But second, that means that there are greater issues at play which could negatively affect the housing market.
Louis, 2019 was a dramatic year, and one gets the sense that 2020 is going to be equally as dramatic.
It's going to be an interesting year, Peter. Our base case, I'm still quite bullish because of the rate cuts, but with caveats. And importantly, over the medium to long term, I have concerns, deep concerns, about the debt, about the sustainability of this pickup. I think it's a good time to sell in 2020. We'll see what 2021 holds, and that will be largely dependent on what APRA does, what the Reserve Bank of Australia does, what the overall economy does.
And if 2019 can prove anything to us, it's that we can have a bust and a boom in the 1 year.
Absolutely. The market is increasingly going from one extreme to the next. And as an analyst, that creates additional uncertainty.
As a real estate agent, it makes it very difficult to advise clients as well, I can assure you.
No doubt about that. Look, it's very difficult to time the market. And I think for first-time buyers, owner-occupiers, it's all about seeing through the cycle, ensuring that you can wear the extremes.
Yes, just on first home buyers, we must finish on this, I think. They get incentives from January 1, the first 10,000 that jump in from January 1, 2020
they do.
To buy a property from the federal government. Do you see that playing a role in the market?
No, Peter, I think it's only going to have a negligible impact upon the market for a number of reasons. Number one, we've had already a surge in first home buyers in the market in 2019. Number two, there's a cap on that incentive. Number three, those who do qualify for the incentive, and there's a few hoops that they have to jump through, are likely to see a higher interest rate, in our view, because the reality is that the banks will be lending on effectively a loan-to-value ratio of 95%, which is an uncomfortable point for them now, and they will probably turn around and say, right, well, since we're taking on more risk, we want a higher interest rate.
So from the first home buyer's perspective, they won't be paying mortgage insurance, but they will be paying a higher interest rate.
That's my bet.
Louis, thanks for joining us today. That was excellent information.
Good to be here, Peter. Thank you.
Thanks, Louis. And thank you for joining us today on Talking Property. We look forward to seeing you next time.